then I'd like us to start. I see we have a good quorum. So we are following up on last week's session on governance for growth. And today Sharon is going to further the conversation. Sharon is going to further the conversation and introduce new concepts. So Sharon, please feel free. Take the stage, and let's proceed. And just for maybe before Sharon proceeds, if there's anyone who wasn't in last week's session and you'd like to introduce yourself and say something about your company, something brief, please do. And then after that, Sharon can continue. Take the stage.
Okay, thank you so much. I'll switch on my camera just for a few minutes so that you can put the name and the face. So I'm Sharon June Akinyi, currently based in Nairobi. I'll be taking us through this session. I'll introduce myself when I'm presenting my slides for you, just to get an overview of my qualifications, my background. I think there's somebody who's not mute. Andrew, maybe you can help.
Yes.
Okay. Those who are in last week, I hope you enjoyed the session. This week we're taking it a little bit a notch higher, but it will not harm just to go back to the basics. I know, for example, for Tawanda, just to get the difference of some of the terminologies that we used. And yeah, please feel free to ask questions. We'll be going through the case. The presentation has case studies. It has one or two because of time. It has questions, so I would really love us to engage so that we also interact in the sense that we learn from each other what we have and what we can do better. Yeah. Allow me to switch off my camera so that I'm able to share my screen. Okay, so once again, welcome to our session. So today we're really looking at governance for growth, so building structures that inspire investors and partnership confidence. We'll really not go into the nitty-gritty because it's more, it's a masterclass. So we'll not deep dive into some of the areas which we would love to, but because of time, we'll just give you an overview. But the most important is to ask questions and to engage so that we can maybe spend time in a particular area where you have interest in. Okay, so my name is Sharon June Akinyi. I'm a risk leader with approximately 16 years of experience, having worked within the telecommunications. That's Airtel, where I'm currently serving as the head of internal audit and risk, Airtel Kenya. I've also served with MTN Zambia. Within the financial services, I've worked for Vision Fund, currently actually a board member at Vision Fund Microfinance Bank Tanzania, where I also chair the Audit and Risk Committee. Consulting, I've been with KPMG as a forensic consultant, and then I was with Ernst & Young as a senior external auditor. I've built expertise in audit, compliance, and risk management across different industries and regions. I've made mentions about my board membership, but I also sit at the Office of the Controller of Budget here in Kenya. I sit as an Audit and Risk Committee member. I actively participate in IOD Kenya, that's the Institute of Directors Kenya, Women on Boards Network, and the Board. Is anyone saying something? Okay. So over the years, I've learned that good governance is not about bureaucracy, but it's about creating trust, enabling growth, and building resilience. My purpose is to really create an impact through transformation, by finding gaps through providing assurance and building solutions for businesses and really ensuring success and moving on to the next stage once the businesses are well set up. So that is basically who I am in terms of my career. Okay, going forward, for today, our overview in terms of coursework. So we'll start with what does governance mean at scale up stage. We'll go a little bit in terms of just definition, going back to basics. What does governance really mean? Is it something, we've made it into such a big name, but what are the basics? What really do we need to know? Then the second part is structuring and evolving your board. So sometimes from advisory to fiduciary. We've had Tawanda who just explained that they have an advisory board, sorry. And then we are going to look at building audit readiness and financial control systems. And then some of the red flags that really hurt us when it comes to governance and when we're looking to either fundraise or we're looking to partner or we're being asked to provide some information by investors or even the regulator. What are some of the red flags that really come across commonly across?
You are there. Yes. See, let me do this. Let me check. I'm picking Tete. I'll show you. Okay. Yeah. You
Hi,
will follow. Yeah. Yeah. Okay. Let me go back and pick Tete.
Andrew? Okay.
Sorry, my apologies.
Okay, that's fine. Okay, so the first question and how we are going to do this is Andrew is going to assist me. We don't have a poll. You can write your answer. Please participate. We can take maybe 3 or 4 answers, and then we can briefly discuss or give an opportunity for the people who've answered to really tell us, to support their answers. So the first question is, if a potential partner or investor asked you to prove your governance strength, what evidence would you show? So I can give you maybe 3 minutes. You can answer using our chat, and then Andrew can pick maybe 3, which we can maybe, we can actually discuss. And Andrew, are we getting some answers trickling in? Okay, can see some.
Yes, we're seeing some answers come in. Amr says executive board structure, decision-making policy. Tawanda, provide board structure, board minutes, in some cases, board path.
Okay. I know Tawanda is not feeling well. I wouldn't want to pick him too. And he's really given us a good introduction to what they're currently doing with reference to governance.
Correct.
Yeah.
Jesse says board agreements, board structure, board profile. That's what you would show.
Okay. So we have quite a lot of people saying, talking about board structures and, things that govern board creation. Anything else people might think that really has something to do with governance? Anything different, Andrew, apart from board?
One of them is I will explain the company's commitment to accountability, transparency, ethical conducts from Abu. Hillary is controls, talent is board composition.
Okay. Okay, so my sense from the answers is we are all significantly aligned to board, things that the board do, board processes, board charters, board. But governance is not only about boards. I like the controls aspect. Somebody has said controls aspect. There's also an ethical, I think I don't know if it's ethical process or something like that. So governance is quite broad. Board governance is just a snippet of what governance is. Before we move on to the next slide, some quick top of my mind areas where governance is very key. You have to look at from a financial controls, you have your financial statements, you have your budgets, you have your actuals, you have minutes are very important. Things to do with your organizational, with your bank reconciliation, your DOAs. So governance is not just about board. And so it's important that we broaden our mindset to what really governance is about. Yeah. And from that, we'll start in with the definition of what is governance and why governance really matters. For this particular end of this chapter, you'll be able to learn what is governance and what does governance mean at scale up? You know, we are no longer at startup where the product and getting customers is very key, but we've scaled up to now really putting structures in place for sustainability and for our going concern purposes. So let's have that in mind in terms of what level do we want to get to. So quick definition. So simply put, governance as to how you make decisions, who has the power to make them, how you manage your resources, and how you really hold each other accountable. These are practically your internal processes. These are your rule books, your transparency, and really your direction. So this one was, we were having this discussion last week, and more so because of at startup level, before you actually scale up, you ask yourself, why do I need governance? Yeah. So good governance is a foundation and not a decoration. The analogy that I have is, if you look at my picture there, that whole building is beautiful and it's quite big at the top, but if you don't have a good blueprint, yeah, then it can easily crumble. Similarly, with our businesses, because at startup, you can scale up very fast and it can be a very fast moving organization or business. But if your foundation is not well rooted, if it's not well rooted to the ground and all that, it can easily crumble. So building a startup without governance is like building a house without a blueprint or foundation. It might stand for a while, but it will definitely crack under pressure. And pressure can be as basic as, we have a new investor, they want to invest $10 million. This is a game changer for us. They're coming in for due diligence, or they're coming in to do their own screening. Then they discover the basics is what we lack. And most of the time, you either get the funding cut or you're given a percentage until you're able to put your house in order, or you don't get it at all. So governance is the blueprint that ensures you can add a second layer or a second story without really the whole thing collapsing. So for investors, partners, and employees, good governance signals that you are reliable, you're well managed, and it proves you're a safe bet. Yeah. So why does governance matter at really scale up stage? So at scale up stage, and having just listened to the current this cohort, especially for Tawanda, and I've read a little bit of profiles, you're no longer a startup. Yeah, you're no longer startups. You have boards in place. You've really proven your product is worthwhile, or your service works. And now your challenge is growth, consistency, and credibility. And just to take an example with Tawanda, you find that now the regulator, not just because you're getting some form of funding from the regulator, but you find that the regulator is really, requesting or demanding for additional accountability. And it's very normal that once you scale up, you attract different stakeholders, investors, customers, employees. So having governance at this stage really means that you need to have a very clear definition of decision making, who approves what, that's your DOAs, what's delegated, and how do we ensure accountability. Systems over personalities. It's no longer a founder's personality, but systems and decisions shouldn't depend on the founder's instincts. However, you should have systems in place. You need to have defined reporting lines where you ensure roles and responsibilities are clear. Documentation, transparency where investors and partners really must see how the business is governed. A quick analogy. So think as governance as a navigation system of a fast moving car. When you're small, your car is moving, when you're that small car, the small, not really a Beetle, because a Beetle can be strong, but a small car, you can really afford to have a few bumps and come back to, to stabilize. But when you scale up and you're driving on a highway at 180 kilometers per hour, every turn, every break, or every blind spot could really cost you. So why would we want to wait for something to cost us significantly? And I think we've seen it and we'll look at one case study where it really, I don't even want to call it a startup, but the business actually went under and it is now under. And that's why it's very, very important that as you're scaling up, and I love that we are getting audited, and we've said we're going to be audited, 3 times a year, but maybe we need to consider having it frequently because of our change of environment. Today, there's no COVID, tomorrow there's COVID. What happens? Yeah, do we have risk registers? Those are some of the things which we need to start putting in mind as we scale up to the next stage. Okay. So in the early stages, like we've said, it's normally the founder's intuition, but at a scale up stage, it really needs to evolve into a formal system. We've already given an analogy, but I'll just go straight into founders to frameworks. So this is where now you're scaling up. In a startup, decisions often involve around the founder, quick, instinctive and flexible decision making. Every decision is around the founder. However, when you scale up to this level that we're talking about, that model becomes very risky. Yeah. And the business needs policies, structure, so that tomorrow, if the founder is not there or the founder quits, what next? Yeah. Can the business be sustainable to the systems that it's already been put in place? So it's very important to have this in place. I normally tell people that policies, the founder can influence the culture at founder level, at startup level, but your policies, your frameworks, and your structures and your decisions will really influence the culture that you cultivate along the way. And we have examples where the founder has influenced the culture of the business, but because they're still holding on as a one-man show, it's still, the reflex to future occurrences is still that culture is still cultivated by the founder. So what I'm really advocating for is that you need to start moving away from a founder mentality. You'll always be the founder, but the business sometimes grows more than you think it can grow, and it actually surpasses one person decision making or one person thought. So instead of the founder approving all the expenses, like I've said, have a DOA, that's a delegated authority matrix, which defines who can approve what, so that there's some form of business continuity. Accountability to stakeholders. So at this stage, there are multiple layers of interest. Like I said, we have investors, we have regulators, we have employees. And it's very important to be able to map your stakeholders in terms of who are those stakeholders who are very critical to your business, who are your stakeholders who need to be informed or need to be kept informed, for example, because one move from them can really, have an impact to the business. And which of those stakeholders, are not really critical, but they're also important to have in place or to be accountable for, or just, for information purposes. So governance at scale up is discipline, transparency, and accountability. From my experience, transparency is very key, but sometimes you find founders, because you lack structures, you're not able to account for every single, not even funding or not even shilling, but even decisions that we make. So for example, if we made a decision or a board resolution for a particular transaction, we're not even able to get minutes, or the minutes are there, but it was not adequately documented. So discipline, transparency, and accountability. Accountability comes in at reporting. What are the kind of reports you maintain? If you have a budget, do you have a budget tracker? Do you have a discussion maybe every weekly? Do you document? Is there any form of evidence that we have the executive committee who discussed this particular, So from audit, we'll come in and we'll request for even the most basic thing as give us the minutes of your EXCO meeting of this particular day when this was approved. Yeah. And sometimes when we are doing due diligences, and these are things that are lacking, it does cost maybe not even the reputation, but it will cost in terms of the results of that particular audit. So one thing I would want us to reflect on, if your business doubled in size today, will your current governance structures still hold, or will it crack under the weight? Andrew, maybe I can get answers for those who think that if their business was to double today, would your current governance structure still hold? And governance is not about board, it's about your finances, it's about, your DOAs, it's about your processes, it's about your policies. Is it well documented? Do you have a well-structured strategy that is in place? Do you have a tracker that, monitors your strategy or your objectives? So I'll give 1 minute only for us to answer this before we proceed. And then maybe I can take any questions after that. Andrew, do we have anything coming in?
Let me check the charts. Abu says no, it wouldn't hold because of the structure.
Okay.
And dynamics of the business have changed. Tawanda says with more funding, we can build a system that brings in full crew.
Okay.
Hillary says, if this question was asked last year, it would not hold. Now it can. That's a good thing. Amr says, no, we don't have yet.
Okay. So it's a reflection we need to have. And when we go now to our next stages, it's very important that now when we're looking at the advisory board or the board, at this level, we need to be talking about board members. But it doesn't really mean that an advisory board is still irrelevant. No. And that's why you'll come to realize why it is very significant to have a mix of your advisory team to be not just people who are expertise in your specific fields, but you include people who have experience either in governance or in businesses who have an idea of what is really required when it comes to, holding fort when it comes to governance. Yeah, so thank you so much for your answers and your honesty. Do we have any questions before I move on to evolving your board? Okay, if none, I'll move on. So we'll start with a case study well known to us, especially those who reside in Kenya. So this is Twiga Foods. So Twiga Foods began in 2014 as a small agri-tech startup collecting smallholder farmers. Initially, their governance structure was informal, their governance was informal and founders made quick decisions. Board meetings were irregular, and at that point, actually, they had advisory board instead, and meetings were irregular and financial controls were basic. So really, as the business started scaling up and hiring staff, attracting investors, Trigger Food was that child who everybody wanted a piece because they were doing something different. They were using tech to really, distribute horticulture across, they came in to help with this whole middleman bag in terms of getting the food to the customer, but something went wrong somewhere at some point. So initially, vendor payment delays were due to poor financial systems, strategic misalignments between founders and investors, and then the risk of few suppliers complained about unfair terms. So what governance gaps did we identify? So they lacked a board structure. Initially, advisory board had limited oversight, and I'll really talk about this, and couldn't provide the fiduciary accountability investors required. They also had weak financial oversight. They didn't have a proper internal audit. They had weak financial reporting standards, there was also unclear decision making where founders made majority of the operational and capital decisions without really a structured approval. So when Trigger Food sought Series B funding, so now they're scaling up, they have gotten $30 million, which is quite huge. Investors insisted on governance reforms. For example, they needed to transition to a formal board with independent directors. They needed to establish an audit and risk committee. Then they hired a CFO they needed to hire a CFO, and also they needed to have an ERP system for financial transparency. Now, this is where you get to understand the difference between an advisory board and a fiduciary board. An advisory board don't have the legal and let me just say legal and not ethical, but legal responsibility towards the business. They are more useful when you're at that starting point where you probably need either business advice, or you need that technical support, or you need to use their networks to expand your business. Yeah, it's good to have an advisory board, but it's not enough. For a fiduciary duty, or should I say the board fiduciary members, they have the legal fiduciary duty. So fiduciary duty means they are liable towards to the achievement of the business, and they're liable to the stakeholders, to the investors, to the regulators, even to the employees. They're liable in sense that they're required as board members to have a duty of loyalty, a duty of care, duty of faith and confidentiality. And in some instances, especially that I've been sitting on boards, I can be held responsible if there's some form of I don't want to say mishap, but if there's some form of either fraud or the business has gone under, and we as board members did not take the responsibility to advise the business appropriately. So board members must act in the best interest of the company, and it's a legal requirement, and its shareholders, and not for personal interests. That's the significant duties. The legal aspect is the significant difference, between an advisory board and a board, a fiduciary board members. And then remember also, for a fiduciary board members, they have the board charter will define their roles and responsibility. And one of them is that they're expected to receive true and true information from management, and they also can demand, because of that whole fiduciary responsibility, they can demand certain things from management. Advisory board might not have, they have very limited oversight. They might not even get into your numbers, your financials, but they just lead you to the right path when it comes to business. So with that emphasis, so transitioning from advisory, so if you don't have an advisory, if you don't have a board of directors, you really need to consider it. And I want to demystify the fact that people think that board directors are expensive, or it's an expensive affair. In some instances, yes, depending on the risk of the business. But then again, you'll find that we have so many professionals who would love to sit as board of directors within your respective organizations. All you need to do is get your networks, and even within the things like LinkedIn, you can be able to get good people who are qualified to sit as board of directors. So in the early stages of a business, governance tends to be informal, decisions are made fast, founders are hands-on. However, at this level which we are really talking about, you must evolve from founder control to a structured oversight. Where formal board meetings happen, and we have independent directors. So independent directors, just to give a quick overview, we have maybe I can say 3 types of directors. We have independent directors, we have executive directors, and then we have non-executive directors. So if I start with the executive directors, I think Tawanda must have given us a good example where he has his exco. So your exco can sit in various board meetings, but they're sitting in as an executive director. A CEO will sit in a board as an executive. These are mainly employees who are associated on the day-to-day transactions or business of that particular organization. Then we can have a non-executive director. So this can be, for example, a shareholder or an investor. They have interests, but they're not involved in the day-to-day operations of the business. It's always good to have one or two persons who represent the interest of the shareholders or the investors. Those are called non-executive directors. And then we have independent directors. So independent directors have no association with the business. They are not involved in the day-to-day transactions of the business. They're not involved in the operational activities of the business. So if I come in, for example, or somebody you can have who is totally not involved in the day-to-day operations, and that person can be called an independent director. That person significantly has no interest. The only interest they have is to ensure that the business is steering in the correct way. They're sitting in for stakeholder interest. So stakeholders can be your employees, can be your regulators, can be, your suppliers. That's the past people who they have interest in. So once you're able to distinguish who is who, you can have one person of each. You can have a non-executive director. You can have an executive director, which you can select from your executive, your exco members within the organization. The CEO is always there, or the MD, and then you can have an independent director. What I've seen in most boards is that they try to diversify. So you get people who have financial experience to be an independent director. You can get people who have regulatory experience. Maybe these are people in the lawyers. If you're big in ESG, you can have an ESG expert. And then you can have people who have got audit and risk expertise to be as independent directors. Yeah. So accountability, like I've made mentions for the fiduciary board, they have a legal and fiduciary responsibility to shareholders. The focus is mainly on governance, audit and risk oversight, compliance and strategic direction, but also there's also an aspect of business. You can have an independent director who is very good at or is an expert in your field to sit in as your independent director. Any questions or comments before we move on? Okay, sorry.
So here my question, June. One of the reasons why perhaps as founders, I've heard in different corridors, why there is a hesitance to move to fiduciary board is the issue to do of losing control, the fear rather of losing control. How maybe you can tackle this if it's part of your presentation, how to remain in control. Because here in Zimbabwe, yeah, I've heard quite a number of stories where founders are actually kicked out of their vision and all that due to these fiduciary boards. And so I don't know how to calm that fear and remain in control.
Just also to add on what Tawanda is saying, one of the biggest challenges that I've seen, a lot of these board members that we will approach will be very, very busy individuals. So decisions, if they are required, are really dragged out because of availability even by itself. Somebody sitting in a number of boards. So how do you balance between the need to keep moving? Even at this stage, you need to keep moving, but also to make sure that you're being assisted to make sure there is that control and oversight.
Yeah. Okay. For the first question, I think should be, I don't know, Tawanda is one who asked. I'll present that when you're looking at our red flags, and I'll give you an example of why it's very important as a founder. You need to start. You need to look at it, the bigger picture. Yeah. As to what really scaling up means. We'll talk about it when it comes to red flags. On the second question, it is actually common and very unfortunate that you pick up board members who will not give you the time that is, and maybe even resources. And that's why it is very, very, very important that before you choose a board member, you must have a TOR as to how many hours or how many days they need to be committed towards sitting on these boards. I can give you a very practical example about myself. I sit in the Vision Fund board in Tanzania, and it's Tanzania. I don't know if we have anyone from Tanzania. Tanzania is highly regulated, and the regulator, especially this is now Bank of Tanzania, is very strict. And when they recruited me, and remember, I'm coming from Kenya, so I'm based in Kenya, but I sit in a board in Tanzania. After they recruited me, they realized that there's a clause in the regulation that says that you cannot do virtual meetings. Yeah, all the meetings have to be physical, and you're only allowed one virtual meeting at the end of one virtual meeting in a year, but with a very good reason. So you can imagine how much traveling I need to do every 3 months. But you see, once you commit yourself, and this is something that you're told on the onset that this is a very high level requirement that you must come and sit. Now, worst case, not really worst case, but now that I sit as a chair, I have to be there when Bank of Tanzania is presenting the basics report. So what am I alluding to? You need to get, and I think as a founder, you'll be able to determine, and you can even put it in your TORs to say, if a board member does not attend this certain amount of meetings, they qualify to be removed from the board. And those are some of the things that need to sit under your board of your board charters. If a board member doesn't contribute or is constantly not available for this amount of time, they're allowed to be removed with approval or with the discussion of other board members. So once that is defined, I don't know who asked the second question, you're able to, it should govern your board of directors, so that you also you're not frustrated from the actions of these people. Is that answered?
Yeah. I think it's answered.
Okay.
And it's just at that level is also just difficult to really get people that can be very committed. Sometimes I think some of these board members, they take more than they can chew. Even the level of engagement and thoughtfulness could be really surfacey. So that is sort of some of the things that I see. And, balancing that and just sending things for people to approve is better than even start thinking and going deeper into some things.
Yeah. No, totally agree with you. Totally agree. Okay. So financial control systems, I thought this was going to be important to just discuss briefly. How do you build audit readiness and financial control systems? Yeah. So audit readiness means, and financial control system is as pure as, one, do you have segregation of duties? Who does your checks and balances? At founder level, the founder does everything. Yeah. Automation and systems, how do you digitize to stay accountable? Last week we gave an example in terms of automation. If your company is 10 employees, you can use Excel sheets, yeah. But if you've scaled up to 100 or even more than, or let's say 50 and above, Excel sheets become a no-go zone, and you probably need to get a payroll system that really helps you with managing your payroll. So those are some of the automation and systems that you need. You need regular internal checks, from your auditors. You can either have a consultant come in as your internal auditor if you're scaling up, or you can have a full-time auditor, maybe at a lower level, an internal audit assistant. Whatever you can afford, it's important to have an independent check for where you are in terms of your controls. Policy manuals, I always emphasize on policies, and especially they need to be documented. And it's just not for startups, even for big corporations. You'll ask them, do you have a basic policy that defines why you're moving A to B or why you're moving B to C? They don't have. And that really is a significant risk, because it means that if anything was to happen, we are not able to substantiate that we actually really do this. And if most cases somebody leaves and somebody comes again with a different way of doing things and we adapt them, then it becomes a problem. But if you have your policies and procedures in place, and if you have a policies and procedures in place, it really creates a culture of accountability, defined and documented. And you can't have it all at the same time. So you have to start small, start with the basics, start with the finance, start with the operations, define them, who is who does what at this point, up to the end. If there's any form of exceptions, how do we go about it? If the founder is not available or they're sick or this and that, how do we go about it? That way, in as much as you're not there, your business is able to continue. Yeah. You need to also know your true position. So reconciliation, so that means this is coming from a financial background or financial perspective, sorry. So at this stage, you can have the best product or traction, but if your numbers don't add up or can't be verified, investors won't stay. And not even investors, you'll have problems. You'll really have problems, even the regulator. When you get, when you're scaling up, you're like I said, you're attracting even the tax man, and you don't have some of these things in place, what are the chances of you getting penalized when it comes to, tax obligations? It's very high, and it's normally very, very costly. It's led to businesses collapsing, yeah? So it's very, very key. Start with the basics, but at this level, it's no longer about the basics. Have an ERP that suits your business, that can actually, give you reports and assist you with your financial control. So an analogy, so think of financial governance as keeping your kitchen clean while cooking. So if you only clean once a year, cleaning means if you only do an audit once a year, you'll face chaos or dirty utensils, expired ingredients, etc. But if you clean up as you go, I think somebody says they have audits 3 or 4 times in a year, then they also have audits from the regulator. As you go washing dishes, as you go organizing yourself, you stay ready for inspections at any time. So that's audit readiness and cleaning as you go. And one thing that I've learned, we have so many auditors in this world, I can't even, phantom it. You don't need the big four, you don't need big audit firms. You have people who can do audits as consultants. Let them come or let them keep you in check. Let them provide, the observations. What can you improve? I know I don't have it in my presentation, but it's very key to have something called a risk register. And even these auditors can even, check what is your risk, how does your risk register look like? One of the risks I picked from Tawanda is that he needs to realize, and I'm just giving an example because you've made mention about it, is that you're in a highly regulatory industry. So one of your risks is regulatory involvement or non-compliance to regulation. So that risk has to be a standing risk for you, Tawanda, so that you're able to go back and see what are all the regulatory requirements that we need at the moment, or we probably might need in future, or are there any discussions about a regulatory requirement that could have an impact to my business? Once you have a defined risk register, it will give you what are some of the root causes of that risk. Maybe it's because there has been increased scrutiny from the regulator. Then you look at where am I, what controls do I have in place to make sure that this particular risk is mitigated? How do I ensure that I'm always on top of the game when it comes to this non-compliance risk? And then you put up the controls. Then if you don't have some of these controls, you now have controls should ideally mitigate your particular risk. Then you have action plans, which now are things you're going to do in future. I think, Tawanda, you've made a comment that you're going to require a PVO for you to fulfill that particular requirement. So that's a future one, but I'm sure because if it's a regulatory one, I'm sure it has timelines. So now you need to measure yourself. When do you need to do this so that you also meet that deadline, and then so that you're also not exposed to any non-compliance fines and penalties. So having a risk register is very, very important. And you can start a risk register by identifying using SWOT, your strengths, your weaknesses, your opportunities, your threats. Your threats, and your weaknesses should ideally be something sitting somewhere in your risk register, because those are your risks. And sometimes risks can become opportunities. You can have a risk which speaks to manual, you're quite manual in terms of manual processes. It is a risk. The risk comes in that because of these manual processes, your systems are not, it's the possibilities of you actually having leakages is very high, because you're highly dependent on manual input from, if you're using Excel sheets, there's errors, there's the risk of losing this Excel sheets and all that. So when you define some of your problems, please create a risk register. Yeah, create a risk register that shows you what are the risks my business are facing. What are these risks that if tomorrow it materializes, my business is gone? Yeah, and you're able to, on a continuous basis. I normally have my discussions with my directors on a quarterly basis, but if it's a high risk, we have it on a monthly basis, so that we are able to know that, okay, we are still on track when it comes to this risk, and we are not exposed. Even if we are exposed, this is what we intend to do. And these controls or mitigating factors that we are going to put in place are able to sustain us for this particular period. We are not able to eliminate the risk 100%, but at least we can eliminate it to an acceptable level. Okay, so that's on risk. So reflection, and just a few questions to ask yourselves. If an investor or donor requested your financial statements today, would your numbers inspire confidence or concern? Are your financial systems investor ready or personality dependent? So personality dependent means dependent on the founder. You rely on one accountant, you only have one folder, you only have one laptop. So that is more on a founder dependency or depending on one person. Yeah. Okay, I'll move on to my next one. So we have one case study for Trigger Foods again. So we already gave a background of who Trigger Foods are, where they are connecting farmers directly to retailers through technology, eliminating inefficiencies in the food distribution chain. So as the business scaled up, multiple countries, daily transactions surged. Of course, there was a lot of, especially from a logistic perspective, there were hundreds of suppliers, thousands of customers, and significant cash flows. The growth was impressive, but the controls and audit readiness was challenging in sense that there was significant inconsistent reconciliation between cash collections and mobile money deposits, gaps in documentation and internal approval processes, complex supply chains without standardizing payment controls. So for this one, you find that before we move into, what some of the governance intervention, for Trigger Foods, it started very well. However, I think they got so much traction from investors that by the time they realized, okay, we've really expanded, we're really doing well, some of the basics were not there. And if you look at some of the things we're talking about is inconsistent reconciliation between cash collections and mobile. And you'll find is that it's as basic as it was being done manually. They did not, as they were scaling up very fast, they didn't think that they would need to get some of these processes and policies in place, or even maybe do additional recruitment of people who are going to handle particular aspects of their growth. And that's why initially I said, you need to look at governance side by side as you're growing. As you're growing your balance sheet, as you're scaling up towards bigger heights, governance must be hand in hand. And governance means your systems, your policies, your processes, your financial controls, all that should mirror your growth. Yeah. So some of the intervention that was made is that the company just had to prove not just performance, but financial integrity and audit preparedness. So they needed to adapt an ERP. We talked about it. They managed to do that. Then they hired an independent auditor, which was PwC, just to ensure in compliance. And there were compliance with the respective financial reporting disclosures. And then also they were able to establish a robust internal control framework. I know for sure they recruited internal auditors, they had a very well structured, and all that structure really was needed. But you see, why should they wait? My question was, why should we wait for larger investors? Why can't we have the basics? And then when we are scaling up, we make sure that we marry these two, our scale up and our governance, so that we don't, we don't experience losses. Because believe you me, for this inconsistent reconciliations, there's some form of leakage that they could have experienced, or some form of, even if it's not fraud, but just, some, even just reputation from their customers and from their suppliers, either delay of payments, or the customers don't get goods because there's all this hullabaloo going on. Yeah. So I think there was a hand up, Tawanda, if I'm not wrong.
Yes, it's me, yeah.
Okay.
Juna, I had a question here. The issue of cash controls, I don't know if you have any practical experiences, because in Zimbabwe, 95% of our transactions are in cash. So that has really created a headache. When I came back from Zambia, we actually discovered that one of our accountants was diverting this cash into their own mobile money, and then so it's now a police case. So I don't know if you have any, it might not be exhaustive now, but if you can share maybe via and what are the other controls to put, and I hate cash because of that. They say cash is king,
Yes,
but not when you're in business. It's not really, it's not, it's the liquid cash is not really king, because we have 11, how to call it, mobile clinics, 11 branches, to put it in your context. And imagine that 95% of those transactions, in fact, 99% of the transactions are actually in cash. So it's a big nightmare. I don't know if you have any experience,
Yes,
in the market.
Yeah. I think for Zim, it's for Zimbabwe, it's different because of your current situation, but definitely cash is king. And I think the only difference is because now you handle a lot of cash. But if you, for example, in Kenya, cash can be, in the bank, in mobile money, in etc., but cash indeed is king. And it's very significant for you to maintain a very good cash flow. So from my investigations, forensics experience, when you want to detect fraud, go where the cash is. That is the secret. Where the cash is where there's high likelihood of having fraudulent activities. And that's why you find for example, here in the telco, we have a revenue assurance department that is very keen on checking on, airtime and mobile money. Those small amounts, we are able to check where, because that is where the cash is. Yeah. So for your example, Tawanda, I think the reason why you didn't pick it is because just a question of, not because, but a question of, what kind of oversight did you have, of who had oversight over this accountant? Ideally, you should have somebody as an accountant, but who oversees, yeah? Who is responsible, for, I think I made mention here, segregation of duties, yeah. Now, you can overcome segregation of duties, or you can bypass segregation of duties if there's a form of collusion. It's very, very possible that a finance director can collude with an accountant. That one is an inherent risk for fraud. However, if you have reconciliations where you are able to check, this is my, I don't know if you're doing clinics, these are the number of people that we have, and this is the cash that we expect. For you, somebody going around the clinics to check that maybe on a daily basis is maybe something, because remember, you're not banking this money. Cash is at hand, is where they are. So you can consider that control, because it is inevitable that where there's cash, it's inevitable. And then also from a fraud perspective, the opportunity, if you look at the fraud triangle, which looks at opportunity, your rationalization, which is your justification of taking that money, and the pressure, which you can't contain the pressure that person is getting. What you can only control is the opportunity. So if you can get an independent person to to go around surprise checks, doing surprise checks on how much cash that person should have, then that could be it. Because remember this point, you don't have a bank rec that you can do reconciliation with, because all the money is at hand. Yeah. So maybe that's one of them. And maybe if we get into details, we can look at other controls which you can pursue for this particular scenario. But in all the frauds, please always focus on where is the money being made. That's where you have a high chance of getting defrauded. Yeah, I think there was another hand.
Yeah, it's me. I just wanted you to expand on the statement that you made, that cash is king. What do you actually mean by that? And maybe it's because I do not understand what sort of business Tawanda does. Maybe that would help to enlighten my mind, because I kind of confused when you said cash is king. Are you talking about a specific region or specific business, or in general?
In general, when you say cash is king, so in businesses, remember, we have different reporting, not really structures, but we have different. You can report on profit, yeah, but you see, profit is not tangible. Profit has different aspects. You do your revenue, you do your, so it's revenue, then you have your cost of sales, then you have your gross profit. But you can have perfect revenue, your revenue, your profits, your EBITDA. EBITDA is your earnings before interest and tax, can be going up every day. You're growing well, you're doing well, your revenues are going up. But the actual cash that you have, the actual cash either sitting in a bank or sitting somewhere for your operations, is what we are saying is king.
Oh, got you.
Yes, yes.
Got you.
Because you could be making revenues, and let's take a very basic examples. You could be expanding across the country, but you're expanding on loans. Yeah. So your revenue is going to be going up, but your cash is going to be chewed by the level of interest of loans or even your operational costs are going up. So if you're doing well in your profit, you've really done well. But when it comes to the actual cash, it's at zero, then there's a problem. Meaning your business is not sustainable. Does that make sense when we say cash is king?
It does make sense. Thank you. Break it down for me. Thanks a lot.
And that's why it's important to look at, maybe if I get time when I'm submitting my my handouts, we can look at the cash flow, statement of cash flow. So there's a statement of comprehensive income, which looks at your revenues up to your profits. And then there's a statement of the balance sheet. And then there's a statement of your cash flow. That is what you need to monitor significantly. Yeah.
Thanks.
Okay. Is there any question on the chat, Andrew, maybe? Okay. If there's none.
I don't see questions on the chat. No, none at all.
Okay, perfect. Okay, so we have deal breakers in governance. So what are some of the red flags? There was a question on this, and how do we build foundations? Okay, so a quick question. If an investor walked in today and asked you for your last 3 board minutes, financial reports, or risk register, could you hand them over with confidence? So if you say a yes, if you say a no, say why, maybe. So you could have board minutes, or you don't have financial reports. So just let me have an overview of where we are. We give ourselves maybe 2 minutes, and then Andrew, maybe you can start reading as we go along. Okay, Andrew, maybe we might start reading if there's anything that has come up.
Yes, yes.
Okay.
So Wanda says yes to all 3, on all 3. Amr says definitely yes. Jesse says yes, we use AI for minutes. Nickel ERP, risk is managed by compliance and AI. And yeah, he goes on to say Nickel is one first startup.
Okay. Perfect. I'm happy that we're using technology to save our time on board minutes. Let's just make sure that it captures everything well. And the reason I'm saying that is because in one of the board, we had a board examination with Vision Fund Tanzania, and that was actually this year. and we got not a very good rating. It was a significant, and significant is not good. That means we have to be reviewed every 3 months to ensure that some of the findings that were raised by the regulator are actually being implemented. One of the findings which we just didn't understand why it was not captured well was that we were not, as a board member, especially the audit and risk, we were not discussing the market risk. But believe you me, we were shocked because we were discussing it. But the reason as to why it was not captured in a board minutes, we have no idea. So it's something we really took up, and we were like, we really need to ensure that our board minutes are well captured of the discussions that we undertake. Otherwise, it's very embarrassing to see that a risk like market risk, which is significant for most businesses, when we're being told that we are not discussing it at board level. Yeah. So just an emphasis, let's make sure that our board minutes capture all our discussions and all our directives. Okay. Okay, so some of the red flags, which are portrayed by maybe founders. So there's something called the founder dominance. So this is a one-man show. So when all decisions, approval, and relationships are controlled by one person, it signals concentration risk. So one of the fears investors have is what happens if this founder burns out or leaves? Yeah. The second one we have is inactive boards, so sleeping watchdogs. So boards that really meet infrequently, or even if they meet, they're not really asking intuitive questions, or they're rubber stamping, yeah, and they really undermine accountability. So investor fear is who is really monitoring this business. Poor financial hygiene. So this is blurring the lines, using personal accounts for business, delayed reconciliation, or really missing receipts are warning signs. So for an investor, if they can't track their money, how will they manage ours? No risk management, driving without a dashboard. So here, you're running a business reactively without really identifying or monitoring risks. And investors' fear is if a risk hits tomorrow, are they really prepared? And as basic as exchange rates, if it hits tomorrow, are we really prepared in terms of managing our forex, our foreign exchange, aspect of it? So I know Tawanda had asked about the founder dominance. So it's inevitable that you have that fear, yeah. And one of the books I started reading when I just started being a board member with these boards that I sit on, it's called Board Governance. I'll share with Andrew that particular book. And that's where I read that Steve Jobs was actually forced out of Apple at some point. I think it should be 1985. And he was forced out by the board. And I think that fear is what Tawanda you have, being forced out at some point when you know you've created this. My advice would be, when you're creating a business, now that you're at the startup, you need to look at the future. It might be bigger than what you might even think. And that's what we all aim for the business to be sustainable. And the governance could force you out of that particular role, in sense that when you have a board of directors, they have fiduciary duties, and their decision actually could force you out. So it's something inevitable. I wouldn't tell you what to do, but it's something that you need to prepare for. And I don't think it's a bad thing. It's only bad when you look at it from a founder's perspective, because I think the proud moment is you've really created this business that has really made an impact to the business. It's made an impact to you. And probably for it to grow to the next level, they might need somebody else or somebody to step in and proceed with the mantra. So Tawanda, is something you need to really look into. If you don't want the business to grow to that level, it is okay. Then that's where maybe you can have control. But if you expand it to significant heights, and you have investors coming in, and you have different shareholders who've got a different percentage of interests in the business, the likelihood of them making decisions that might not suit you is very high, because you'll still be governed by the founder syndrome. So it's a both way. So if you want to choose, maybe you leave it at that scale where you have control. But if you expand it and want investors, want to grow it, want loans, even banks actually can dictate your governance, yeah? Because maybe you want funding, you want access to money and all that, and they'll tell you, no, we need this structure, we need to have this in place, we need to have that in place. Then if you want that to be something that you look in future, that it's something, then you should try and consider it. Maybe Tawanda, you can comment on that, or what are your thoughts?
Yeah, definitely. We want to grow.
Mm.
Want to grow the business to unlimited scale up, or unlimited size. The catch-22 is always, even if it grows, I think it needs a bit of more coaching on how to retain control. So I don't know if it is true. It's a question.
Okay.
Someone said to me, when you are giving shares, someone wants to buy into the organization, you should never go beyond 27%. Is there a rule of thumb to say you give so much control, you must remain with so much control? Because yes, I know the story of Steve Jobs and many, especially in Zimbabwe, many people have actually been kicked out of their organizations. I don't want to say it's a worry. It's the least of the worries, but however, how it's done in most cases is very, there's a lot of acrimony behind that. So I don't know if you have any other ways to foolproof that in as you want to grow, you also want to be sure that, you have got a board that then, works for you and the organization, in as much as there are many other external stakeholders, which I get, because for us, we are growing our microinsurance offering. So definitely I know that the regulator is going to come hard on us to perhaps do the fiduciary, thing. And then the follow-up question to that is also, do you decide on fiduciary based on some revenue indicators or size of revenue, to say is when you are doing $1 million sales or $1 million revenue, or do you have this rule of thumb so that it becomes also more like a line that I have to follow through that, and mainly because as you put it there, because we are startups, I don't have enough. I'm not generating enough to kind of hire C-level type of experts, like the chief financial officers, chief marketing officer. We're having to do with lower to mid-level style of skill sets. So the other question then would be, just to buttress my other question is, do you have at least a range to say, when you start consistently generating X amount of revenue per year, then maybe it's time to think about, because it's also costly to do this kind of fiduciary board of directors, because they then also expect a little bit more, in terms of their sitting time and all the work that they have to do for us. So I don't know if you got my questions, but yeah,
Yes.
I'm happy. We want to grow, but we also want to grow in a way that we remain, in what we are doing.
Yeah. Okay, I'll start with the aspect of, I think you asked about shareholding, how much is too much to give. So it depends, Tamanda, it depends on your negotiating skills, especially when you have people who are interested as investors into your business. It depends on how they negotiate and how much they're offering. Some people will come in with so much funding that they'll demand a bigger share. Yeah. So I think different businesses or different industries have different not really requirements, but it's all different depending on the scenario at the moment. Sometimes an investor will come and they might not give you funding, but they might give you support maybe from a technical perspective, and they will just give them maybe 1 or 2%. Yeah. So definitely, you depending on the value of your shares within the company, if you have less than the control, if you have the non-controlling interest, then you're more likely not to have power to make decisions or control over the decisions. And this sits with the controlling interest. That's how it works. And from my experience, that's how I have seen it. So it depends with the different scenarios that come. And sometimes I think even you find instances where loans are converted into shareholdings. So at that point, what happens? So you need to bring in the evaluation of the business, you need to bring in other aspects to actually quantify maybe the loan in terms of shares and how much worth it's going to be. In terms of knowing when to scale up, so when you're a startup, when you're just starting out, your main focus is on products and really getting acquisitions of customers. But when you get to a level where now you're scaling up, where product in the market is stable, your customers, you're getting good traction of your products, and you're even looking to either expand geographically or you're looking to expand your products, then it means, and your cash flow is allowing it, then it means you need to start putting in some of this governance requirements in place. And and you can hire an accountant. You don't need a CFO where you know very well an accountant can do the job. A CFO will only come in at a level where you've really scaled up. You're no longer even being called a startup. You're a whole business in itself. And you've even broken even at some point. That's when you might need a CFO to oversee, some of these direct finance functions. But at that level where you're just maybe doing, I wouldn't put a benchmark to it, because remember, different businesses have different thresholds. You can do an industry benchmark if you have some sort of market share, or even if you don't have market share, but at least if you have some form of visibility, then it means you're growing. Then it means you need to start scaling up. Yeah. I don't know, the last question, I don't know if I've answered all the questions or I've made comments towards all the questions you asked. Okay, I think I don't know if we had another hand. I don't know if I saw Hillary's hand up, if I'm not wrong.
Yeah. So I just wanted also to just put in some of my 2 cents on some of the questions, just to turn it into some discussions. He asked about the directors that basically come in with investments, because that is determined during the negotiations in terms of if they want voting rights, how many voting rights are they looking at in terms of what needs to be voted in. So I think voting rights will come in. Of course, somebody brings in money, they will want voting rights. And how does that voting right, if, for example, the voting rights gets to a place where people can basically vote you out, I think the 27% is really, I don't think that, that is, you can own 60% of a very small valuation, but you can own 10%. Like one of the companies that I worked with, I know right now the founders have raised Series B, and combined they own less than 15% of the company, because throughout the, all the way from pre-seed, seed, and Series A, they have been, they have been, diluted downwards, but the value has really increased, even if they hold that and they still hold the voting rights, and you have three co-founders or something like that. And even if the other directors are 2 or 3, the investors really want you to succeed. I don't think that a lot of investors will come in to try and fight the founder, unless that, because why should they fight somebody that is going to make them money? And I think that moving towards institutional investors might be a better bet for a lot of startups, people that have portfolio companies, rather than talking to an angle of viewers who will give you money and basically kick you out. So I think that there be better structures with a lot of institutional investors that look into that. So as long as, for example, you are giving, Series A, Series B, even that is what, Twiga did. By the time they were raising Series B, the founder had been diluted downwards, and the investors really had the majority, and they thought, maybe this is not the guy, and they basically kicked him out, and that is how sort of everything went down. But it's a neither here nor there kind of story. Some people will start working with the founder and realize that there was a lot of coverage. There was a lot of, there was a lot of hiding things around there. They bring their own CFO, they bring their own auditors, and they find that, there was a lot of bandages applied, and they just say, maybe this is not the right thing. So it really depends, and have different people with different motivations. But I think most structures in investors will be a better bet, because they will want you to succeed. That's just my 2 cents.
Perfect. I think that's very good, Hilary, when it comes to answering the question, and thank you for actually giving examples on that. Was there another hand or a comment? Feel free to unmute and just go for it.
There's a comment from Lolo.
Okay.
Yes to board minutes and financial report. I'm not sure if that's answering the question you had just asked.
Yes, that was the question I had just asked. Yes.
All right.
Okay, so winding up, or should I say winding down, building investor-ready foundation. So the first thing is strengthen leadership and board structures. And what I can advise is, I know there's the fear of having board members. There's all that fear about having board members. They might not commit to the time and all that. But, and maybe they might be expensive, but you'll be shocked what you can get around in terms of people who are actually believe in, because remember, as a founder, you're the vision bearer. You're the one who carries that vision. They believe in you. You might be shocked as to people who are willing to volunteer to sit on your boards, maybe just for a year or 2 years, also for them to build their portfolio and also to succeed with you. So I would recommend you really try it out. We have quite a lot of, if you go to maybe even LinkedIn, you'll find a lot of board networks that are available. And even within your own networks, you'll find 1 or 2 people who are actually willing to sit on your boards for a very, maybe all they need is facilitation fee, which is either just airtime here and there, data just to attend, or even just transport and all that. Very, very limited, because by the time somebody knows that this is a startup, they should actually understand that you might not have the financial muscle at that point to really pay them, you know, in comparison to already established entities. So cultivate a culture of governance culture and not just systems. So governance is a culture, and the culture actually sits with the founders, because the founders are the first people who actually bring in about the kind of culture that we can adapt. I can give an example, though I don't want to mention a particular bank here in Kenya, where the founder is really the forefront. And from just the hearsay we've had here, it's a very difficult culture that they're facing, but they're doing very well. They're doing very well. They've expanded. but it's not the easiest to work for, because the culture that was there initially when it was being founded is the culture kind of still prevailing in this situation. And it's a culture like, you know, they have their formed systems, they're highly regulated. But when the boss says now is a now, yeah, there's not that aspect of, oh, we have systems, we have processes in place. So what am I really emphasizing on is, please create a culture where you respect governance, create a culture where you respect processes, and not processes that will stifle your business, but processes that will enable your business to better heights. Formalize risk and compliance frameworks. I'm happy that most of you noted that you have risk registers. Don't complicate it. For now, make it as basic as you can. And a risk culture is where you just identify what are some of the roadblocks I might face in future. And it might not be now, but what do I need to do to ensure that if this comes, I'm ready for it? Yeah, so those are some of the formalities you need to make for risk and compliance frameworks. And other things when it comes to governance is, don't sit with everything as a founder. Try as much as you can, especially for this level where we've now scaled up. You know, create some form of business continuity so that even if tomorrow you're not there, or you've now ventured into other businesses, this one has to run on its own. It has to have its feet. Give a proper foundation for that business to scale up. And I think once you have a proper governance, once you've really established your business, from what I've experienced, you're easy to have a higher negotiation, or can I say higher banter? Higher banter is where you're more likely to get more in terms of value of your business. When you have very strong governance structures, when you've scaled up your business is doing well, the value of your business, actually your balance sheet goes up and the value of your business goes up. But if you think that your product is very marketable, but you have shaky structures, you have a shaky foundation, it's easy for it to be picked, especially by, for example, if it's specialist, it's very, very easy. So that will be my parting shot. This should be my last presentation, my last slide, sorry. I'm open to questions if we have any, or comments for anyone who wants to make a comment. Okay, I think there's Abu, if I'm not wrong, raised his hand or her hand.
Yeah, I do have a general question.
Okay.
It's surrounding the governance structure. So basically what I wanted to know, so that if you look across the whole region, Africa, there are certain parts of Africa that are heavily regulated, where there's been structures in place for very, very long time. And then you have other parts of, particularly like the east part of Africa or southern part of Africa. And then if you move to other region, they just in the primary stage of putting robust mechanism to regulate. So I wanted to know, in that case, if you operate in an environment where regulators are just in the process of trying to establish stringent measures in terms of regulating, whether it's fintech or insurtech or anything of that nature, would you refer to that as a blessing or a curse, like generally?
It could go both ways. So sometimes regulations do work in our favor. Yeah, either they protect us from certain things, or they just put things in place to have to ensure that maybe there's good competition. But from my experience, most regulations could sometimes hurt us in terms of cost of compliance, in terms of the duration you're given to comply, and as a business person, as a founder, you already know your the industry you're playing in, or you're building your business in. Please create relationships with the regulators. You'll be able to know which regulation is coming, which one is not coming now. You know, I can give a good example. Within East Africa, and I think also with Southern Africa, the regulators share knowledge, yeah, and they share these experiences. So you find like here in Kenya, data protection in terms of regulation is really, really stringent, yeah. I wouldn't be shocked if Uganda in the next 1 year, they've just picked some of our laws, they've exchanged ideas, you know, they've interacted, because they do interact quite a lot. And they have, you know, implemented this in Uganda, and, you know, any business person in Uganda gets hit. So depending on the industry you are in, please it is actually one of the most important things you need to do, form relationships with the regulators. You must always be ahead to know what is coming or what is not coming. It's inevitable for, especially here in Africa, new governments come with their own way of working. So if you know your country is going for elections and there's likelihood of change of governments, you need to anticipate change of regulations, either to favor them and consequently could also impact our business from a cost of compliance perspective. Yeah, I hope that answers the question.
Yeah, sure, thanks.
Okay. Okay. Any other question or comment? Okay, back to you, Andrew, maybe for conclusion.
Thank you, Sharon. I particularly enjoyed that session because I'm having talks on governance, or we're having talks on governance in another life that I have aside from Holistic. So this has shed some light on some few things I need to clarify. So other than that, thank you for this session. I would advise anyone in the cohort, please go to June's LinkedIn, follow her, and also, if June, you don't mind, if I share your email with the cohort, so that if they do have any questions or follow-ups, that they can interact with you freely.
Yes, Andrew. I think that's why we are here, and that's why we chose to facilitate some of these sessions. So yeah, you can reach out on LinkedIn and just introduce yourself, that this is where I'm coming from, and ask questions if you want, maybe references to people within, with this particular expertise, trustworthy people. I'll be able to assist where I can. You're also able to, Andrew, you can share my email. I'm open to that. I have no problem.
All right. Thank you so much, Sharon. We do appreciate you. And I will be reaching forward with any next steps. Team, thank you for attending. Thank you for interacting really well with Sharon. And I hope this isn't the last we see or hear of Sharon. It is my hope, but then we will speak as a team to see that. But please create linkages, create networks. That's how we learn and sharpen each other. Thank you for this session, and I wish you all a good evening.
And quick recovery to Shubi Tawanda is not feeling well, but he was able to get through the whole session. Well done, and quick recovery.
Thank you very much, Sharon.
Okay.
All right.
Thank you, everyone. Have a good night.
Have a good night.